everyone. Thank you for coming tonight to talk a little bit more about investing in 3D. Before we get started tonight, though, I want to publicly thank our sponsors who made tonight possible. We have Invesco, we have Allianz, Eaton Vance, and Hartford. So can we put together a warm thank you for their support. Now it's my pleasure to introduce our speaker for this evening, Sean Mcdermott. Sean is a certified financial planner with Lpl Financial. He teaches investment and retirement planning courses at several Fortune 500 corporations and colleges throughout the Twin Cities. He has over 22 years of experience teaching and advising clients. Sean's education background and qualifications include a graduate of St. John's University, Bachelor of Science degree. He is in financial planning and a minor in accounting. He's a registered investment advisor, a certified financial planner, and a licensed life health agent. He also is recognized by the Minneapolis-St. Paul Business Journal and also the Minnesota Monthly as a top wealth advisor. Sean is married and has 2 sons, Logan, who is at the University of St. Thomas, and Landon, who is 11, and also has a daughter, Alexa, who is 6. And he enjoys coaching youth sports, playing golf, and volunteering for his community. So ladies and gentlemen, put your hands together for Sean Mcdermott.
Thank you. Thank you. Good evening, everyone. Boy, it's been a crazy market. I slept awful last night. I have a horrible crick in my neck. I feel stiff as a board and a little flat today. Oh, actually, folks, I'm right over here. That's not me. This is me. Good evening. The title of my presentation tonight is Investing in 3D, and you can see the difference 3D makes compared to the 2D effect. So that's what it's all about. Hopefully I look better in 3D than 2D. Is this okay here? So what the point or the things that we're going to talk about tonight is how important it is to look at the 3D aspects of investing, not just two-dimensional aspects, the charts and the graphs. And so we're going to cover a lot of interesting ground this evening. And some of the main topics we'll be talking about, first of all, is we're going to talk about the market volatility. That's always a fun subject. It seems like every year when I do my talk up here, the market plummets, and here I come. So hopefully that's not a coincidence, but we're going to talk about the 2D perspective of investing and how we need to open up our minds and talk about 3D investing, all the different avenues and angles and things we need to look at and movements in the market in order to make good decisions at the right time so we can make money in times like this. And then we'll talk about keeping the faith, 2011 and beyond. We'll talk about market outlook and where we see things going off into the future. Sound pretty good?
Good luck with that.
All right, we'll start off with a couple of the headlines here. These are headlines from earlier this year. In April 6th of 2011, unemployment rate falls in 3/4 of US cities. And the Dow at that point in time was actually 12,426. So the market was doing pretty well this spring. And then we went into the summer months. And what do we start hearing about this summer? Greece, right. It was right back to Europe and Greece and the debt problems over there, just like we had last summer. And then to top it all off, when we got towards the end of July, do you remember the Federal Reserve said, hey, we're running out of money here, and we need you to raise the federal debt ceiling. And so Congress was trying to pass legislation to allow for the federal debt ceiling to increase, and they say it was like if a couple went into a banker's office and was sitting with the banker applying for a loan, and they started arguing back and forth about the loan. Well, I'm not going to pay it. Well, I'm not going to do this. I'm not going to do that. That's what it was like with Congress arguing. You know, the markets got very nervous about that, and as a result of it, we had the downgrade of the U.S. debt, went from S&P downgraded to AA instead of AAA. So it was a pretty messy fall A lot of negative headlines with the dollar, weak jobs, things turned around. There's some pretty big drops in the stock market. This was the biggest drop, and that was on August 5th, 2011. Do you remember this one? Front page of the Star Tribune. Dow drops 512 points in one day. That's pretty scary stuff. And then here's a week later. This is one heck of a roller coaster with the stock market. Nobody's ever seen anything like this before in their investment experience. On Monday, the Dow opened up and it went down 634 points. On Tuesday, the market went back up 429 points. Wednesday, the market went down 519 points. Thursday, the market went up 423 points. Isn't that crazy? So everybody in here called me for an explanation, and fortunately I was out of the office that week on vacation. Nate was in by himself. Where is Nate? Thank you, Nate. So it's been a pretty crazy market, a lot of market swings. The last couple days have been pretty much the same thing, with the Dow had a couple good weeks and now it's back down again to below the levels that it was at earlier last year. I love this news headline that came out right after Hurricane Irene. Monday the market opens up and the Dow went up 2%, and of course the news headlines read, oh, well, the Dow went up 200 some points because the Hurricane Irene wasn't as bad as what we expected it to be. So the media is always trying to find explanations and reasons and make headlines with the market these days. And that was one of the craziest ones that I saw. So since 1990, there have been 5,445 three-day periods. Only 4 times has the market fallen 10% in a 3-day period. Unfortunately, of those 4 times that it's fallen more than 10% in a 3-day period, probably just about everybody in this room has experienced at least 3 of them. And that was in 2008, 1998, again in 2008, and now in 2011. So that was the 4th worst drop in the stock market in a 3-day period over the last 20 years. So a lot of volatility that we're living with these days. Tough being an investor. So since 1990, there have been 5,447 trading days. Only 29 lost more than 4% in a single day. 21 happened between 2008 and 2009. And I'm thankful I didn't have to revise my slide presentation. I just kept watching the close of the market today, and really close to having to redo all these slides again. So 2 have happened in the trading days around August 8th. So again, major volatility, unprecedented events that aren't very normal. Now the good news is, out of all this, the market historically has recovered from down periods. Basically in the 5 days following a down period, the average up in the market was an increase of 3.6%. And over the next 20 days, the average is an increase of 7.1%. We looked up the numbers, and since August 8th, the market has gone up about 3%. And over the 20-day period, it might be down maybe, I'd say maybe 2% at this point from where its low point was. So there has been some recovery. So we kind of like to view the market, it's like investing in a fun house these days. I have, as Nate mentioned, 2 younger kids, a 7-year-old and an 11-year-old, and they keep me young. And when I tow them to the state fair, my little daughter always wants to go in the fun house. It's always fun for her, probably more fun for her than it is for me. You guys probably remember these fun houses. Anybody been in one in the last couple years? You have the tunnel that spins around and you lose your footing, and you have the shifting bridge and the ropes, and you have the mirrors and the flashing lights and the buzzers, and it's kind of a little crazy. And the mirrors play tricks on your mind. So you look in one and your head looks like an alien, and then you're taller and skinnier and fatter and all these crazy things. And so the funhouse distorts your point of view and gives you optical illusions. And so we're going to talk a little bit about why the market is something like a fun house these days. Sometimes it's not so fun, though, is it? Okay. We gave you some 3D glasses, so we will make the presentation fun if we can. And this next slide, we have a couple slides in here that are in 3D. So this next one here is one of our 3D images. So you can put those on. Fold them up, put them on. You all look pretty good. I should have a picture of this. Jim, have Nate come with his iPhone next time, and this is pretty funny. You guys all look really good. So this might not, I mean, we have some images come out a little bit better than other images, and this isn't one of our better ones. If it doesn't come out, are you supposed to have the red to your right eye or your left eye?
Red to the right? Oh, red to the right. Oh, that picture had it.
Who knows? I don't think it makes a difference. Okay. Okay, this one is not in 3D. This is not in 3D. I'll let you know when they're in 3D. So basically the mirrors, what they do is they end up giving us optical illusions. And oftentimes we live in a very 2D world, and our brains function very well in a 2D world with charts and graphs, simplicity of headlines. The headlines say this, we react this specific way without looking at all the other avenues. Okay? So what we want to do is talk about some of the optical illusions in the market, some of the things that can trip us up, and I want to talk a little bit about some of the illusions that play with our brain a little bit. And you may have seen this one before, but this is what I'm going to do here. I'm going to have you count the number of F's in this sentence that I give you. And you don't need 3D glasses. I know they're cool, Jeff, but you don't need them. He actually sees better, he says.
You look better.
I look better, yeah, thanks. Okay, so I'm gonna go to this sentence here, and what I'd like you to do, just to yourself, count the number of F's you see. I'm gonna just show you this for about 10 seconds, okay? Ready? Okay, now, let me ask you a question. How many people in here counted one F? How many counted two F's? Okay, anybody count three F's? Okay, pretty big number. Four. Few people. Anybody get five? Did anybody get six? Okay, let's do it one more time. Here you go. Okay, so I got a pretty smart group of people here, and you're all very smart. How many people got three? How many people got six? Anybody? Couple. Okay, good. There's actually 6 F's in this sentence up here. There they are. Isn't that crazy? So your brains, everybody in here, you're so smart that you don't need the little words. You don't need the little F's to solve the problem, to read the sentence. You just completely overlook the ofs. Okay? So we're wired so we can skip the little details in life. And oftentimes that's what happens in investing. And that's one of the first mistakes we don't want to make, and that's overlooking the obvious. Let me talk about some of the obvious things. These examples here, I'm going to pull up over the last couple years and tie them into the optical illusions. And so we're going to talk a little bit about the past history of the market, and then we'll get more into what we foresee happening into the future. So this chart here actually talks about 2008, when the stock market went down quite a bit. And so as investors, everybody had their eye on the stock market plummeting, and at the same time what was happening, there's other parts of the market that were also blowing up. It was basically carnage, sell now, ask questions later. One of these areas was bonds. And what happened with bonds is they reacted to the stock market and they both went in sync, and that's downward. And what that meant is if you're a bond investor, you could be buying bonds, high yield bonds especially, that were trading at 20 to 24% discount. So you could buy bonds that are paying 20 to 24% discount. So what happened is good portfolio fund managers, a lot of people, I can't name any specific mutual funds, a lot of my clients own these types of mutual funds, they actually loaded up on all the bonds that they could. They said this is the best buying opportunity they have seen in their careers. It's the lowest bonds have been in 50 years, and they loaded up on them. And what happened is as the stock market and confidence started to return to the financial markets, these bonds took off just like stocks. And so sometimes investors, individual investors, overlook the obvious and aren't able to react and get into these opportunities. So let me talk about this next optical illusion here. I'll ask you, what do you see in this? Probably nothing. There is a bird in this puzzle here. And you'll look at it a long time, you won't be able to see it. There's so much noise in this. And now, here's the bird. I'm highlighting the bird for you. Okay, watch it. Probably still don't see it, do you? No. It's there. It's there. Okay? So there's so much noise and there's so much detail that our brains can't figure this out. There's just too much for us to comprehend in a short period of time. Okay? So I just want to back up a slide here, and I want to do something. Now, one of the things that we are wired for is movement. So if you're sitting down, if you see somebody moving, your eyes are attracted to that person moving. You'll probably watch them move by, right? So when things are moving in the market, or when the picture is moving, then you go, ah, there it is. So watch when we start to move this bird around. You can kind of see it. It's there. You know it's there because you can see it moving. And we're kind of wired like that. Kind of interesting, huh? Okay, so sometimes we're wired when the stock market is going up, we're going, let's move. Let's get this money in. When the market's going down, let's move. Let's, it's tied into the emotion. You want to do something about it. Okay? So now, do you remember the T-Rex? Remember what the T-Rex couldn't do? Remember the movie Jurassic Park? Remember that scene where the T-Rex is attacking the family and Dad says, "Don't move! He can't see us." And the kids and everybody stood still and the T-Rex came right up to him and couldn't see him. Couldn't chase him, couldn't kill him, couldn't eat at them. Because its brain was too small. The only thing it could do is see movement. Okay? So kind of the same thing for investors. Sometimes the only thing we do, we're wired a little bit like a T-Rex. Our brains are too small, I guess. So, all right, there's a 3D slide for your fun. Is that one a little bit better?
Yeah.
Has anybody been here to the Tree of Life in Disney World? And they have a 3D animation show, and you sit there and they actually have like mist and different things that come down on you and spiders, and it's really cool. It's the best 3D you'll ever see at Disney. Okay, let's talk a little bit about perspective and how perspective can change things. So what do you see in this slide here? You see the pretty princess. You've probably seen this before, right? So this is your perspective. It's a pretty princess. And I'm going to say, well, let's talk about the pretty things about the stock market and what's going on. And this is what some investors are seeing, some professional investors are seeing. Record U.S. stock market earnings. So 10.17%, that's the highest quarterly profit numbers as a percentage of GDP since tracking in 1947. So the stock market had its highest earnings in 64 years. the first part of this year. Tell me how many people in here have seen that in the headlines before? It's been there, not much, because the media doesn't want us to hear about that sort of thing. It's too positive. But that's where it's at. The earnings of U.S. corporations the profits are up 19% for the second quarter of 2011. Those are some pretty good numbers, aren't they? And it doesn't stop overnight. It just doesn't, it just doesn't go negative 19% for earnings in a day. 97% reported at least 10% growth versus the economy at 0.7%. So remember, as an equity investor, earnings, earnings, earnings. So when they asked Warren Buffett what he thought about this market downturn, he has said he is buying everything he possibly could. He hasn't seen stocks this low in 20 years. And I'll show you that in a minute. Okay, so there is some positive. Let's change the perspective on this. Same picture, flipped it over. Upside down. You see the ugly part of the market, the ugly lady. So here's some ugly numbers in the market. And here I'm going to change your feelings on all this. 2 minutes ago you're thinking, positive, pretty, I like this class. Let's talk about the negative, jobs mess, pretty ugly. August 2011 created 0 jobs. It's pretty shocking and alarming. In 60 years, this is the first time this has happened. First time in 60 years, not a single job was created last month. In 2007, the unemployment rate was 4.7 or 4.5%. In 2011, the unemployment rate stands at 9.1%. Probably everybody in here knows somebody that's been impacted by unemployment or job transition. Okay? Interesting fact for you that I found. College grads, the unemployment rate is half of 9.1%, 4 points, like 4.2%. So that is a help for people that have higher degrees. Lower unemployment. So why is this? Why is unemployment so high? We call it the axis of evil. Here's 3 things. Maybe not so evil, but they are bad if you're unemployed. Number 1, older workers are not retiring. Anybody in here delayed retirement for a year, 2, 5? Let's see it. Anybody in here delay retirement? Yeah, I know a few. So I used to hear, when I started, I've been doing this for 22 years, and I used to hear people say, I'm going to retire at 55. And then they turned age 55 in the year 2001. Remember the stock market? It's down 50%. So they said, well, Sean, we're going to wait a couple years. We're going to wait till we're 58. And then they got to be 58 and they said, I think we're going to wait because we just found out our health insurance premium is going to be $1,200 a month until we reach Medicare age. And then we don't even know what it's going to be. So they delay. And then they say, well, we'll wait till we're 62 and then we should be fine. 62 comes along and it's 2008. What happened to the market in 2008? Carnage. Again, way down. They don't feel comfortable with where their investments are at. And then 2011 comes along. They're saying, okay, full Social Security age. I should be good now. Full Social Security benefits. I'm on Medicare. I can always go back and work part-time if I have to. So a lot of older workers are delaying leaving the workforce because they're not comfortable with the idea of their portfolio generating the income. They're not comfortable with healthcare premiums. They're afraid of longevity. Anybody think about that? Live until you're 90, 100 years old? Yeah, you could run out of money. You don't want that. Next thing, small businesses not hiring. So they say this is the lifeblood of our economy, is the small businesses hiring new employees. And the fact of the matter is, they're not hiring. 2 reasons for that. And this is the truth. And I'm not going to sugarcoat it, because we work with a lot of small businesses, read a lot of trade journals. Small businesses are afraid to hire because of, number 1, healthcare costs. That's coming up in 2012, where they have to pay for their employees' healthcare. If you're a certain size business with 50 employees, everybody has to have healthcare through your company. If you add in an employee now, what is that healthcare going to cost? Who knows? Could be $1,200 a month for all we know. Second thing is unemployment. insurance. So if you hire an employee, and let's say the economy goes back into a little bit of a downturn, and you need to lay that employee off again, and that employee goes on unemployment, you know how long you can collect unemployment? 99 weeks. Do your math, that's about 2 years on unemployment. Where does that money come from? It comes from unemployment insurance benefits that the small businesses have to pay. So it's kind of a catch-22 to help people, but yet it ends up hurting our economy in a certain way. Big businesses. Are big businesses hiring? A little bit. But I've seen a lot of early retirement offers at companies like Medtronic and 3M. Major corporations saw a lot of that going on in 2008 through 2011. And the companies, what they did is they did one round of layoffs, then they did another round of layoffs, and they never hired anybody back to replace those workers. And so the people that are left working might be doing the jobs of 2 other people or 3 other people that used to be in the department. Anybody experience that in here? Where you just go, you know, they could really use somebody else to help us out here, and it just doesn't happen because companies are trying to have the biggest bottom line that they can have right now. So it works great for corporate earnings, but it really doesn't help our economy as far as the unemployment picture. So the jobs, you know, and if they start throwing in things like all the people that have been working in the housing industry, you know, housing isn't coming back very strong. The construction workers, whether it's Florida or Nevada or wherever, you know, it's not good. It's going to take a while to get these numbers down. Let's go back to the pretty princess. Okay, how'd you feel after I talked about jobs? Not good, right? So let's talk about something better. Okay, this is the global economic outlook. And this slide, I'll try to explain it the best I can. We have on the top part here, these are the developed market countries. These are the emerging market countries. This is the real GDP growth of these countries. So here we have Australia, United States, Canada, Germany, United Kingdom, France, Japan, Italy, Spain, South Africa, Poland, China, India, Indonesia, Russia, and so on. Okay? So this bar chart is, in the blue, is 2011, the growth of these countries, of GDP growth. So the Australia is growing at, roughly 3.5%. United States is probably closer to 2% right now. Canada is growing at over 3%. France is growing. Italy's growing. Spain is growing. South Africa. China is growing at over, close to 10% GDP growth. Does anybody in here see a country, or can you name a country that's going negative right now as far as GDP growth?
Greece?
Maybe Greece.
Ireland?
Maybe.
Italy?
Portugal. Italy is growing positive. Italy is at over 3%. Spain is at is close to 2%. So there's very few countries. Most countries are growing and expanding and doing just fine. Okay? So again, people don't know about this. You think the world is like falling apart and everything is negative, 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 but we're not in a recession. The only thing that could create a recession right now, or one of the major things that is starting to create a recession, is the media. And I believe it. I have clients, and include myself, because I'm at my computer all day long, and my homepage is Yahoo Finance. And every time I look at my computer, and I just talked to one investor today, maybe 2, and they watch the markets on a daily basis all day long, and it doesn't feel so good. They're just trying to find some news, some better information, some breaking news, and it never does come. Who knows what moves the market right now. But long term, these are good numbers. GDP growth and expansion of the world. So one of the countries that's expanding quite rapidly is China. 2011, statistically, China has 1.3 billion consumers, 1.3 billion people. Vehicle production was up 13.5% in China. So Ford, GM, Chrysler, tremendous profits. Can you believe less than 5% of people in China even own a car? Isn't that crazy? It sounds like the early 1900s in the United States. So they want cars. They had the longest traffic jam because they're buying cars, building highways. They have traffic jams that are 70 miles long and last for 3-4 days. You hear about these in the paper, it's really bizarre. Industrial production is up 13.2% in China. Retail sales up 16.5%. That's some pretty strong sales growth, wouldn't you agree with that? And so 16.5% is actually too good. And why it's too good? It creates inflation. So the Chinese government is raising interest rates to slow their economy down. Too much money chasing too few goods. Stock market's earnings growth, 22%. Starbucks, 470 coffee shops, projecting 1,500 shops by 2015. If you Google McDonald's in China opens up a new restaurant every day. For the next 4 years, they'll open up a new restaurant every day. And they have 1,300 now, they'll open up 700 more. They have 50,000 employees in China. So now, Apple revenue. You think about cell phone usage over there. Very few people have home computers. You know, they're not wired. They don't have Comcast and Quest and DirecTV. So they buy a cell phone. They'll buy like a smartphone, like an Apple or a BlackBerry, and they can do all their web applications right on the phone. They can watch TV on the phone. And so Apple, they can't keep up over there. Their revenue was up 400% in Greater China. So you look at companies, the technology companies, they're doing just fine. Now, if you think of our S&P 500 companies, most companies are multinational. Whether you're 3M or Medtronic or any company you can name, they're selling all across the world, to all these nations that are expanding and growing and doing just fine. Okay? So things aren't necessarily as bad as what the media might make you think. Now, this is kind of interesting to look at. There's this thing, you probably never even heard of it until this year, called the VIX. The VIX and the treasuries. The VIX is actually the price of S&P 500 future contracts. The higher the VIX number goes, the higher the price. So if there's a lot of market panic or anxiety, there's a lot of institutional and investors that are trying to buy options or future contracts on the S&P 500. So the higher the VIX goes, the more panic there is in the market. So you can see this blue line here is the VIX in 2008. Just about went off the chart. Market was scared into horrible panic here. And then things kind of settled out. 2010 in the summer, you know, things are volatile. And then look at it again, you know, there goes the VIX. It's volatility in the market. This other line here would be our U.S. Treasuries. It's on an inverted yield curve. So here's 6%, and then here's 2%, 1%, 0%. And the higher this number goes, or this graph goes, the lower the interest rate. So when things are volatile and there's panic and nervousness in the market, people take their money and they put it into U.S. government bonds because they're safe, supposedly. And so the more people that put their money into U.S. government bonds, the lower the interest rate, the lower the yield. Because there's so much money going into them, they're below 2%. Okay? So even when the S&P 500 or the S&P rating service downgraded the U.S. debt to AA, that next day there was more people going to U.S. bonds than ever before. It's just crazy. So it was unexpected. So that's our VIX and treasuries. And here's on a scattergram, basically on the vertical axis here, we have the U.S. Treasury yields. Typically they're in this range here, kind of the nervousness of the market. And on the horizontal scale, we have the VIX, and that's the panic, nervousness of the market. And again, you can see that right now, it's a very panicky state with the stock market. And we're going to talk about that in a second, what to do. So now what can happen is there's certain overreaction levels, and from time to time, if investors do overreact, they can end up selling out at the bottom or making big mistakes. And right now, I know everybody's nervous about things. You know, there's no doubt about it. Even the professionals are nervous. Nobody has knows the future and a specific answer as to the number one question right now, and that's what's going on in Europe. That's the problem. It's not our US stock market, it's not the earnings, it's not the unemployment rate. You know, those things kind of take care of themselves. Everybody's worried about Europe. Everybody's worried about Greece. And obviously Greece is not going to solve its own problems. Basically, here, if we spend more money than we take in tax revenue, we print more, right? We just create more money, raise the federal debt ceiling. Over there, they can't do that. They have to find money from someplace else. They don't have a Eurobond. They have to keep borrowing from the central bank over there. And the central bank, as I said, we can't keep loaning you money because we know you can't pay it back. And your citizens aren't willing to pay it back because they'll just go on strike and say, I'm not going to come to work today. And that's just the way it is. So eventually everybody knows that they'll probably have to default on those bonds. And what the concern is what kind of impact will that have on European banks and the European financial system. Our analysts at LPL have said over the last couple of years what the banks have done over there is they've divested themselves of the Greek debt and Italian debt. And they've gotten it off their books to very, very low levels. So if something does happen, it's not going to hurt them. You know, they've sold all that stuff off to venture capitalists that want 18 to 30% return on their money. Okay? So they don't think it'll have as big of an impact, but it's a big media event. Again, it will take time to solve these events. It's going to take a lot of time because there's a lot of countries working together. And you can see the dysfunction in our own government, but try to work with, 8 governments at a time. It's really hard. So it's going to take time, and this volatility just is not going to go away overnight. Another optical illusion. Can you find the hidden face? Can you find the hidden face in the coffee beans? A lot of you are probably looking and you're going, oh, can I see the eyebrows? Can I see the mouth? Can I see the ears? I'll show you the hidden face right there. Do you see it now?
Oh my goodness.
So it's easy to see when I tell you where it's at or where I tell you what you're looking for, okay? So when I said look for the hidden face in the coffee beans, probably most people in here, including myself when I first saw this, I wasn't looking for a little face. I was looking for a pattern for a big face. I can figure this out. Of course you can't because you don't know what you're looking for. So did anybody find it right away by chance? Okay, good.
I don't see it now.
Try the 3D glasses that Jeff has for you. So it's another optical illusion. If you don't know what you're looking for, it's impossible to find it. And I want to talk a little bit about, I want to go back to some 2D investing. And this is from last summer with what was going on with the markets. So when we came out of the recession, the unemployment rate went down, and many people were becoming employed. But then in the last summer, it took a sharp turn downward. And the idea was, well, maybe the stimulus effect is wearing off, whatever. So, people were just like, okay, not a big deal. Let me throw another 2D chart at you. Manufacturing rolled over. So last summer, all of a sudden, boy, manufacturing's starting to slow down. Throw another chart at you. New orders slowed down. And then this one will really scare you. Same store sales fell dramatically last summer. Put all those 2D charts together and it's not good. But then what happened next is there started to be some unexpected little tidbits of decent information in the market last year. And most forecasters thought the market would end up pretty flat last year. But after I taught this workshop, the market ended up having some pretty big returns. I think I finished up a positive 12% last year, all because of this workshop. I hope. Yeah. So the idea behind this here is that there was some economic surprises, and then following that, the market took off and went up. And if you're only focused on, gosh, same-store sales fell, manufacturing's turned around, unemployment is slowing, or employment is slowing down, and looked at only these things, last year people would be not in the market and not have had a good return by the end of the year. So again, we got to watch out and not get too caught up in some of these numbers, daily numbers. How about this one? Can you see the hidden face? This is Machu Picchu. Let me turn it. It's pretty cool, huh? So looking for the face in these investments. So again, we don't want to just follow the crowd. We want to be looking for the hidden numbers in all this. Of course, we don't want to overuse these numbers. We want to look for them, but don't overuse them. This is an interesting chart. This is the Economic Surprises Index from earlier this year. And here would be in the yellow line, that's the S&P 500 axis. And you can see it went down quite a bit in August. And then here would be the Economic Surprise Index. And you can see that started going down in April. So that's actually one of the indexes that we use in one of our management programs, and we saw it going down in June. So anybody that has the thing called the SAM program, we actually took half the money out of the market, out of the S&P 500, because some of the technicals, some of the fundamentals were starting to erode. So good news is half of the money is in cash before the market went down. And now we're looking and saying, okay, where are the buying opportunities going to be? You know, it's like if you can sell a stock at $42 a share and buy it back at $30 a share, that's the way to invest. Sell high, buy low. How about this one here? Flat or sloped? The gray line. See these gray lines? Flat or sloped. You know it's flat. They are flat, but you put those boxes in and it creates an optical illusion. Your mind, again, can't see these things. This is interesting. This is a study that was done by Jan Suman. And what he had is 4 hikers, and he said, I'm going to give you 30 minutes. I want you to walk through the woods in a straight line. You have no compass, you have no GPS, just walk in a straight line through the woods. Anybody that's a hunter in here has probably done this with and without a compass. It's very difficult to go in a straight line. I have some crazy stories about that. But so the first 3 people that he said to do this, he followed them with a GPS so he could track them and make this chart here for you. The first one went just like this. Started out, did a couple loops. This is in 30-minute time. Next one, same thing. Couple full loops, went around, got straight there for a while. Another loop here. Then the third one, just all over the place. Okay? Fourth one ended up going in a pretty straight line. Difference being, fourth one, it was a sunny day. That gave that person a point of reference on the straight line walk. Okay, so he always had the sun over his right shoulder. So the main point of this here, of what we're talking about, is what does this teach us? And what it teaches us is we need a plan. We need a plan on how to walk a straight line and how to make it through the woods on a cloudy day. Let's talk about that. We're going to talk about the 3D. What's the plan in 3D? First one is diversification. 1,000-year-old principle, don't put all your eggs in one basket. How do you diversify? Well, there's diversification with investment styles. So what investment styles are, it would be like investing in growth or value, or maybe an income investment, or something really conservative. So if you're retired, you probably have a part of your portfolio that's in fixed income. And the stock market went down, And you go, oh, well, not a big deal. My fixed income, where I get my income from, hasn't moved. It's fine. It's actually gone up. So that would be an investment style. You might have one style that's aggressive growth, and you go, well, I knew that's what was going to happen. It has a lot of volatility. I have time on this investment. I don't need it tomorrow. I'll just leave it alone. When I retire in 3 years or need it in 5 years, then I'm going to use it. There's different asset classes. By asset classes, what we're referring to there would be things like stocks, bonds, real estate investment trusts, commodities, precious metals. You know, there's different ways of investing. Regions and industry sectors, you can invest in China. You can invest in an industry sector like technology or agriculture or metals and mining. So there's a lot of different industries, a lot of different regions. And then of course there's the product mix. The product mix would be saying, you know, our three main themes with our firm would be having dividends in your plan, that part of your portfolio. Second thing would be having managed products that hedge risk on the downside. So when the market gets bumpy, become more defensive. Third thing would be guaranteed products like variable annuities. That if the market goes down, you go, I don't care, it's guaranteed. They can never take that away from me. It'll keep going up, says right on that statement right there. Okay? So you can ride out the market volatility because you know that it continues to go up over time. So those are some of the ways that you can smooth out risk through diversification. This is kind of interesting to look at. It's the 20-year rates of return on different investments. Don't know the best place to stand for you guys over here. So 20-year annualized return by asset class. You can see real estate investment trust REITs actually have averaged 10%, 10.5% average annual compound return over the last 20 years. So it ends up being number one. We're actually increasing our client recommendations up to 10% in REITs because of the dividends. Oil, then you have the S&P 500, gold, bonds, EFA, which is Europe, Asia, and the Far East, homes, average investor, they say, inflation. And then you see some different investment style, kind of a traditional portfolio, and traditional asset classes would be like your 401ks, where they give you stocks in the US, stocks internationally, and bonds. So those are your three main investments. Outside of the 401k, a lot of investors are using more diversified portfolios, adding a bigger mix of products. And historically, what that'll do for you is that it actually increases your bottom line return and reduces the volatility or the standard deviation on your investment portfolio. So diversification is very important. Secondly, dividends. I love this quote. This is from John D. Rockefeller 100 years ago. He says, the only thing that gives me pleasure is to see my dividend coming in. You might have parents that used to get their dividends sent to them, sent to their bank account. They weren't crazy, were they? You go, why do you have all these sent out? They love it. It's great to get a dividend. Stock market's going down, you're still getting your dividends. Bond market's going down, you're getting those dividend checks coming in. So the cool thing about dividends is you're always getting paid to wait, right? You're getting paid. And that's important. The last 10 years, if you didn't have dividends, you're not getting paid anything. You just took on all that risk for nothing. So one of the themes, again, we want investors to increase and go for the dividend. Because if this market is flat for the next 5 years or 10 years, and if you don't have some sort of dividends coming in to buy more shares or for income, then that's not a good thing. So we handed out, there's a white book. I think we handed out the book on investing with dividends. If we didn't, you can grab one on your way out. These charts are actually in the booklet that was handed out. And what this first chart, it shows since 1970, if you had $100 invested in the market, it'd be $5,364. If you subtracted out the dividends, you'd only have $1,400. So the dividends make a big difference over time. 1926 to 2010, the dividends accounted for about half of the return of the stock market. And here again, we're looking at a 40-year period, we're just saying, okay, the dividend growers and initiators outperform all dividend paying stocks. The dividend cutters are companies that are reducing dividends like the banks had to do, or if you see a company doing that, there's a reason for that. The dividends come from profit. So if you have good earnings and you're selling a lot of product or creating a lot of service, you have a lot of cash and you're just saying, okay, here you go. You're the shareholders, here's your money. Here's for taking the risk. You're paying the owners. So when a company starts to cut the dividend, something's amiss. You're probably going, something must be going wrong with the profits, or their industry might not be right. And so you got to be wary of these types of companies. So again, maxing out the dividends we think is important. And now the ways of generating good income become harder and harder in the last few years because interest rates are getting so low. You heard about the government, they said, okay, we're going to keep interest rates low for a couple years. You know, what does that do for fixed income investors? Not a lot. So if I have an investor and the investor says, Sean, I need $1,000 a month of income. And I say, well, gosh, you know, I have a money market that could pay 0.75%. Or maybe you can go to the bank and get a CD that pays 1% or 0.75%. Rates are pretty low. Wouldn't you agree with that? It takes $1.6 million invested at 0.75% just to get $1,000 a month. Not a lot of people have $1.6 million and want to put it in a bank account. If they have $1.6 million, they probably never had a bank account. They probably had stocks and investments all along, right? Here's if you own dividend-paying stocks, you know, just a pure dividend-paying stock portfolio, 2.1%. It's not that great. I mean, you're not going to retire only on dividend-paying stocks unless you have a pretty big portfolio. So it takes $571,000 to generate $1,000 a month. Here's if you look at the average bonds in our country. Again, interest rates have come down, they've been down, and they're probably going to stay down for a while. 2.4%, that's not that great of yield. So a lot of investors, if you're going into bonds, you pretty much need to use strategic bonds or strategic income funds because they'll look globally for bonds. So if you go, remember we were talking about China earlier? You know, their interest rates are a lot higher over in that area, in the Asian countries, than they are here. So a strategic bond fund manager can look globally for their bonds, and you can get that yield up to 5%. Here's REITs. Anybody own a REIT in here? Real Estate Investment Trust? Okay. So right now, 6.5% pure cash, $1,000 a month, takes $185,000 invested. So that's why these things are so popular with retired investors, because they're just going, okay, I love it. I have my dividend check coming in every month, just like clockwork. Doesn't matter what happens with the stock or bond market, because my REIT doesn't go up and down with the stock or bond market. All right, that's one area we're recommending the clients to increase over the next couple years because of the better yield, and it's not subject to the low rates of the bond market. Third, discipline. Discipline in investing. This is pretty eerie, pretty scary to look at. You might want to shut your eyes on this one. Here's the 2008, the S&P 500 dropped 666. That was the drop, 2008. August 8th, that was the big drop in the market, 6.66. Is that eerie or what? It's been a devil of a market, hasn't it? Okay, so how is the market similar to what it was in 2008? We're not finding a lot of similarities. So 2008, when the market plummeted, it was pretty much a recession. There's consumer spending was way down, business spending was way down. 2011, there's still a lot of strength in our economy here. Again, corporate profits are good. Things are actually pretty decent in this country. Manufacturing is not in the basement. So compared to 2008, the manufacturing is still going quite strong in our country. Tim, you work up at Federal, and how's Federal doing?
We're expanding right now.
Expanding, growing. I heard Hoffman Engineering growing strong, you know. Anybody else work in manufacturing in here? Your company doing well?
And we have Caterpillar and Bobcat are really going strong now.
Caterpillar and Bobcat. I have a slide just on that. So business equipment, tools, manufacturing is very strong in our country. You know, there's some weak spots. Might be in housing, might be in some other areas, but it's not that bad. How about this? Consumers have less debt. This is a chart, goes back to 1995. Because the media talks about, oh, everybody has so much debt. 1995, let me just go right here, debt service ratio, and that's the blue line. The debt service ratio in our country is about the same as it was in 1995. Yeah, it got pretty high in this period here, but what happened, a lot of people have deleveraged. You know, they went through this last recession and going, that scares me. I want to get rid of that home equity line of credit. I don't want to buy a car. I want to pay cash. I want to pay off the credit cards. So actually that's a good thing for our economy because consumers are in a lot better condition than they were in 2008. A lot less debt. Consumer sentiment. Anybody heard of consumer sentiment? Consumer sentiment. This is tracked by the University of Michigan. And basically what it tracks is bad economic policy by our government. So it's bad policy by the White House, bad policy by Congress, bad policy by the Treasury Department and the Federal Reserve Board. So it tracks these things, bad economic policy. Here's the figures. Everybody sitting down? U.S. consumer, first let me tell you this. In 1999, it was its highest level at 40%, a positive 40% in 1999, okay? Right now, U.S. consumer sentiment dropped to its lowest point in more than 3 decades in early August, as fears of a stalled recovery gelled with despair over government policies, a survey released Friday showed. So people are scared, it's saying here, even though the economy's not bad, but they're afraid of the government. It says bad times in the economy were expected by 75% of all consumers in early August, just below the all-time peak of 82% in 1980. Remember 1980? That was hyperinflation, you know.
How much of that is dependent on what how the media is presenting it?
This has nothing to do with the media. Well, it might be what the feeling of the public goes, but this is University of Michigan. It's not a slanted media study.
Okay.
They're calling this as completely politically neutral. This is University of Michigan. They don't care if you're a Democrat or Republican or independent or where you're at. They're just calling up people and saying, what do you feel about the government? What kind of job?
But I'm saying those people's opinions
Comes from the media. And that's what we've been talking about all night.
Yeah, and so I wonder.
So consumer sentiment is getting beat up right now. Let me continue on. It says, excuse me in here if I offend you, but the Obama administration received poor ratings from 61% of respondents, the worst showing among all prior heads of state. Never before in the history of the surveys have so many consumers spontaneously mentioned negative aspects of the government's role, Survey Director Richard Curtin said in the statement. So what this is telling us here is confidence in our system and our government is very low right now. And it's probably not going to get much higher over the next couple months. And it's a very important number. Wouldn't you agree with that? So we have, pretty much a dysfunctional Congress right now. And probably not a lot going to happen in the next year until the next election because you got the House, you got the Senate that are divided. We have the things coming up with the debt commission and the debt ceiling again. That's going to be another battle. And it's even worse over in Europe. And so that's all impacting consumer sentiment. If consumer sentiment is bad, people might tighten up on their spending a little bit. And that's what the market is kind of forecasting a little bit right now, because 70% of our economy is consumer spending. So if consumers aren't happy and are worried and concerned, that could have an impact on future earnings of stocks. It hasn't happened yet. So one of our analysts' opinion is that during the last recession, the baby boomers never stopped spending money. When things get tough, they go shopping. It's true. You know, we spent ourselves right out of the recession. So who knows? But again, you know, people aren't happy with what's going on with the government, and I think a lot of people in here probably had that conversation with their friends. We talked about Europe and what a mess that is, and that's the biggest impact on the market. Every time there's a little tidbit of good news coming out of Europe, it helps prop up our market. The market goes up. So watch for that in your investing, because that's going to be a key element in making this market turn around in the next couple months here. Macro risks are perceived to be low. This is actually the TED spread, the inner lending between the banks. It's very low right now, meaning there's a lot of confidence in the banking industry. This slide here, I'm just talking about the 2010 compared to 2011. 2010 started off pretty rocky, or actually pretty good. And so did the stock market this year. And then 2010, there was a Gulf oil spill. Seems like a long time ago now, doesn't it? Remember, that was in the headlines just every day. When did they get this thing capped? And then we had the Japanese tsunami this year. You know, remember the headlines there? And I mean, it was 24/7. You know, what is this going to do? Are they going to have to evacuate Japan and China and all the Asian countries because of this nuclear fallout? And then we had, now it's the European debt, our last year, same thing this year. Then there's a rally in the markets because they seem to have the problem solved for at least a year. End of year return, 2010, 13% on the Dow. And so, again, you know, there's a strong possibility, based on a lot of the numbers I gave you tonight, that the market could easily go up before the end of the year. Now, some of the things that, as equity investors, are very important to watch. One is the PE ratio. That's the price of the stock and the earnings of the company. And the PE ratios of stocks right now, they're trading at, I'd say, about 11 times earnings, maybe 10.5 times earnings. And you can see in this chart here, you'd have to go back to 1989 to find stocks priced at the rates at the price that they're at today. So the 20-year average is 16 times earnings. Right now, stocks are trading at 20-year lows. Buying opportunity? This is based on current earnings. Here's the future earnings, the forward PE earnings. Same thing goes here. Stocks are actually very low in price right now. So maybe if you're a long-term investor and saying, yeah, you know, all this stuff over in Europe and the United States, it'll work its way out eventually. So if you're an equity investor, some of the smarter investors are trying to take advantage of this market right now because they think it's a good buying opportunity. Of course, you have to be able to ride out the risk, have the discipline to stay with it. Okay? So let's take a look. Got some 3D slides for you at some different sectors. This is one sector we feel is going to be a strong grower and benefit in the next couple years. And this is U.S. machine and tool orders. In July of 2011, $484 million. That's the highest it's been in 10 years. So it's up 272% since 2009. That's why they're busy. You know, the world is still growing, still expanding. Agriculture, there's been famine and drought and a lot of problems in this world. And so agriculture prices are going up. There's more people to feed all the time. So that's a good investment. Then we have our metals and mining, very strong demand. So we think that's going to continue to be a good area to be invested. Probably one of the strongest growers right now is technology. You know, businesses and consumers are doing a lot of spending in the technology area. And this is just a picture of a computer screen that you can see through and touch screen. Anybody see that special on IBM computer that was on Jeopardy?
Oh, yeah.
What's his name? Watson. Yeah, wasn't that amazing? Did anybody see the thing that was on the special? It was like a 1-hour special, how they built Watson. And you know, it took a long time. It took 4 years to build that computer. And they said the Watson has the computing power of 600 home computers, and it's about the size of 7 refrigerators. And so they initially, when they had the Jeopardy executives there, because they said, we want Watson on Jeopardy, and they said, okay, we'll bring in some of our top contestants that have been on Jeopardy in the past, and Watson just got blown away. And then what they had to do is they went back to the drawing boards and they taught Watson how to think based on the answers of the other contestants. And so it's really an amazing story, you know, what technology is doing right now with finding solutions to questions. And then of course Japan, we still think Japan is going to be a strong area. There's a lot of, after the tsunami and the earthquake over there, or earthquake and tsunami, there's a lot of rebuilding, very strong economic growth in Japan, so we're a little bit overweighted in that sector. That's Mount Fuji in Japan. So what we want to do, if you have questions, feel uncomfortable about the market volatility, call us, call my office. Every one of my investors should be positioned already defensively. You should have investments that are suitable for where you're at. And there's always going to be volatility, but the alternatives are put it at the bank at 0.25%, and it'll take a couple $1,000,000 to generate that $1,000 a month. Nobody wants to do that. So you almost have to learn how to put up with the volatility. We have to look beyond the 2D. We have to look beyond the fun house of investing. The moving floors, the flashing lights, the mirrors that distort and create illusions in the market. There's a lot to comprehend. We have to look for the face. Remember, it's hard to find a face unless you know what you're looking for. So whether it's Machu Picchu or the face in the coffee beans, we want to take that 3D outlook. Keeping the faith, you know, keeping the 3Ds in mind. Diversification. Dividends, making sure you're getting paid to wait. And then the discipline of staying the course with your portfolio. Remember what I showed you in 2008, remember what I showed you in 2009. Things looked bad, but then they got good really quick. And so again, if you got to keep the faith, keep moving forward, look for that pretty princess that'll eventually show up. With that, I'm going to wrap up. This is a quote. We got football season here. Bill Blankenship, life is sometimes unfair. Will you be bitter or better? Bitter or better? So keep a positive attitude, keep a long-term perspective in these short-term markets, and thank you for coming tonight. Appreciate having you. Before we're going to have our door prize drawing, and if you haven't introduced or haven't met Nathan Crampy, Nate, could you come up here a minute? And Joel Budd, I just want to introduce you to some of our staff here tonight, and Russell Rogers. They're all here, and Jim, why don't you come on up here? So Jim Hall, he's been with our firm for about 6 years now. He was with 3M for 29 years. He's an engineer, electrical engineer by trade, very analytical, does a lot of the research with different products and so forth. We have Joel Budd. Joel's been an investment advisor for 22 years. He and I went to college together back at St. John's. And Nate Crampy. Nate's a graduate of the Carlson School of Management, been an advisor for six years? Yep. 6 years. Fully licensed financial planner. So when you call him to the office, if you need help with anything, a lot of times you'll speak with Nate. And Russell Rogers, he's the newest member of our firm. And Russell's been in the business for 3 years. And
Since 2007.
2007. So 4 years. So he's a senior advisor now. Sorry, geez. But Russell's actually, he's a Bethel grad. He comes from the upper UP of Michigan. Mm-hmm. He's actually a first lieutenant in National Guard, Minnesota National Guard. He's active duty right now. So Russell, he'll be available to help and answer questions whenever you're calling to our firm, along with our team up here. We have a couple door prizes for those people that brought referrals tonight. We have and I'll just turn it over to Jim.
Sure.